across to Mr. Ramesh Iyer, the Vice Chairman and Managing Director at Mahindra Finance, to tell us what does he make of this entire move. Hi, Mr. Iyer. Good afternoon. Thank you so much for speaking with ET Now. First up, your first word in terms of what does it mean for the entire industry and the sector? How are you looking at this extension?
No, so if you recall November when this circular came out, I think all of us felt that there is a requirement of at least some more time for us to be able to communicate this practice to the consumer. And therefore, we had, as FIDC, had made a representation to RBI requesting that grant us time so that we could go back and communicate to the consumer as to how should their repayment in future be. And I think we are definitely as an industry very happy to have received this extension, which will help all of us to be able to streamline this process by September. Definitely the customer segment that all of us work with are not the ones who can really pay on or before due date, etc. So that will be a separate discussion that we will engage in. But to start with, getting the additional time is a very, very welcome move, and it was very, very much required, and we are very thankful to RBI for considering this request, and this will help the industry for sure.
So when we talk about M&M Finance, in Q3, NPA stands at 11.3 versus 17 post the circular. It reiterates its commitment towards bringing down the stage 3 NPA below 4% by year end. Throw some color on this. Help us understand the impact on provisioning front as well.
So clearly, after the first quarter results itself, we had set out very clearly saying that what had caused the increase in NPA was due to the severe pandemic second wave impact in rural, and therefore the gross NPA had gone up. And we believe definitely that was temporary in nature, given the nature of the consumer that we work with. And we had put out a number saying that 80% of that provision would get reversed by 31st March 22. And by December, we had already reversed 60% of the provision that was made. And we are very confident that we are in line with what we had made commitment of the reversal at 80%. And therefore, this very, very clear commitment that we will bring down the net NPA to below 4% by 31st March. And you have seen our January collection efficiency on a year-on-year basis. It is higher than the previous year. So I think things are going right for us as of now.
Okay, Mr. Iyer, that point is taken. But looking at the current market construct, help us understand the business momentum and the credit demand, because January 22 update signals healthy disbursements and recovery. So tell us, what are you looking at and which are the pockets which are witnessing growth?
So one thing one needs to understand is, rural continues to remain under some kind of a pressure because of, various activity, the economic activity is just picking up. And we are very confident that this will revive even further from where it is. So far as the vehicle demand is concerned, we are seeing continuous footfall at the dealership. Demand is high, but the supply has been a little weak from the OEM side, and therefore that has impacted the overall volume and growth. But again, we understand that from the OEM that this is getting fixed and the volumes must increase and the inventory will start going up, and that should help the retail volume. Every geography across the country has witnessed sentiment return to normalcy, growth coming back, and with a good monsoon, good yield, good support price, I think the farm cash flows have held up. Definitely, what we are all waiting for is also the infrastructure opens up, and you would see the rural definitely bouncing back. And my own take is next 3 years should be good for rural with the infra also opening up.
Can you share with us the outlook on funding cost and margins for now?
So clearly, we do expect in 1 year's time, the borrowing cost will slowly start moving up, maybe 25 basis point, maybe 40 basis point. But the good news is, as far as we are concerned, we were always a very well-matched ALM company. And therefore, if the cost was to go up, it would still be lower than some of our past borrowing, which will mature, which we would borrow fresh. And therefore, the overall cost for us should not really be going up, while the marginal cost of fresh borrowings will be slightly up by 25 basis point or so over a 1 year period. But understanding of the market is also that once the interest cost does go up by 25 basis point, 50 basis point, it gets repriced to the consumer, and therefore the lending rates will also slightly go up. So we don't see pressure of margin through this, but clearly the borrowing cost in 1 year time can move up by 25 basis to 40 basis point.
Okay, Mr. Iyer, thank you so much for that.